Just before we begin, I want to thank our generous sponsors of this series, especially our gold sponsor, KPMG. And we would also like to thank our 3 Silver Series sponsors, which include Ventura Realty, Cregan McConnell Group, and TD Bank. Steve, thank you so much for joining us.
Well, thanks a lot. Glad to be here.
So I must tell you, I think the story of your formative years I found it incredibly inspiring. And everything from you working in your father's linen store to being state champion in track to the transformative impact you had on your peers in the Army and the Ivy Leagues. So it's clear how your grit and your commitment and your creativity have brought the global powerhouse of Blackstone into fruition. So perhaps we could start the conversation with those that impacted you. And maybe I could begin by asking, what's the best piece of advice or wisdom that anyone has ever imparted on you?
Well, there have been a few. The first was, don't drop out of Harvard Business School like I was thinking of doing. That's one good piece of advice. I found it a little boring, by Christmas of my first year. I called my previous employer, a guy named Dick Generette at Donaldson Lufkin Generette, which was a major securities firm, and told him I wanted to drop out. And he told me that he wanted to drop out also. He found it boring, and he was going to go to the economics school at Harvard and become a PhD. And he didn't, and it worked out fine for him. And so I shouldn't, and it would work out fine for me. So I guess proof of concept. That was good advice by Dick.
All right, sounds great. And so, okay, so you founded Blackstone, at this point now more than 35 years ago, and after this remarkable career at Lehman, and clearly it's been an extraordinary success. But can you maybe share with us, what was your original motivation driving you to launch your own asset management firm? And notwithstanding your orientation towards solving really big problems, like, did you ever dream that you'd end up sitting here today?
Well, I didn't dream I'd be sitting here today, but everybody on this call is in some type of family business, and these businesses get established one way or another. And there's always a series of factors that lead to that. In mine, it was because Lehman was where I worked. I was head of the merger department at the time, and the firm got into real financial trouble. Either you were going to change the management, bring in some external capital, or the firm was going to get sold. And I was asked to sell it in 3 days because we actually had no net worth left because of a bad trading position, which was a secret. Once those secrets are no longer secrets, then your liability structure typically collapses. You lose your ratings, and that's the end of your business. So I sold the business, and the American Express. When I approached the American Express to sell it, I told them I didn't want to stay with the company because I didn't think selling it was the right solution. It needed a management change, and the guys 10 years older than me were on the board, and they were worried about protecting themselves. They didn't want to stand up and take on the CEO, who was the problem. And so we ended up selling the business, and then through a series of misunderstandings, if you will, the board of American Express decided if I didn't stay, they weren't going to do the deal because I was pretty well known at that point, and so I got stuck staying for a while, and I wanted to leave for the same reasons, had nothing to do with American Express or anybody at Shearson. It had to do with my not wanting to be with the Lehman people, because I don't believe they did what I thought at the time, and this is a funny word, the moral thing. Sometimes you put yourself in jeopardy to do the right thing to protect an organization and its continuity. They chose not to do that, and so I didn't want to be with them. It's just as simple as that. So when I left, I had pretty much of a non-competition agreement, and so the only thing I could do was in an area that we weren't, which was in the buyout area and some M&A. But we ended up doing a settlement where American Express got part of the fees for a limited period of time in the limit of my non-compete. But basically, I couldn't join a big organization the way I normally would. And so it left me starting one that was smaller with the former chairman of Lehman, who had been forced out, which created the problems. And so the two of us were just like basically I think it was like 2,000 square feet. He had a secretary. I didn't, because we capitalized ourselves with $400,000 of money, which if it's your own money, it's a lot. But in the great sweep of the financial community, it's not much. And I just watched that money like in an hourglass, like the sand going out. And we sent letters to 500 companies. We thought we'd be deluged with business, and most of these companies we knew, and nobody responded. And I thought the mailing, those were the days when there, 1985, when there was mail and not email, but snail mail. And I thought whoever brought it to the post office, it just got lost because nobody ever responded to us. So we called all these companies, and at the end of it, we still didn't get any business. So for those who like starting their own company, talk about not much fun, talk about frightening. This is like cosmic rejection.
Yeah.
So after a month of just sitting in an office with nothing happening, I said to my partner, I said, Pete, what do we do now? He said, we wait 2 more weeks, we call them all again. So that's a very innovative strategy. And we did get somebody to hire us for $50,000. And that was less than any legal bill I had gotten in my career, at Lehman. And, I guess the rest is history, much painful, because entrepreneurship is only a great thing when it works. And 9 out of 10 things don't work. And we had some close calls. Now, of course, one of the most profitable and largest financial institutions, certainly in the money management area in the world. And our market cap is around $74 billion today. That's a lot more than the 400,000 we started with. But the amount of rejection you take on the way is truly a humbling experience. And I'm grateful for everyone who gives us money. And I don't forget anyone who gives us money. Now we have a lot of money, and I used to fly across the United States to raise $5 million from somebody. Now we have people who give us $1 billion or $2 billion. Not everyone, but some do, I even got somebody to give us a commitment for $20 billion, which is the second biggest in history uh, of sort of alternative asset money raising. But part of what you need to do as a I guess you'd call it managing partner or whatever, my title is to have everybody else not forget that every investor is a privilege that they give us money, and we must do a great job, because our business is pretty simple. We're like a restaurant. We're only as good as our last meal. Nobody who gives you money cares about your life story. They really just want you to do what you promise them. And so we have an obligation to always make good on that promise. First, don't lose money. And secondly, deliver the kinds of returns that we tell people we're capable of. And that plus innovation of going into new areas has, sort of created us way, way, way bigger than everybody else in the world. So people look at us and go, geez, you guys must be a big deal. I look at it just the opposite. Every day is a new day. If we don't do what we promise people, we won't end up having much in the way of assets. And that ability to pass that on, that hunger, that commitment to excellence, that uncompromising sense of energy, openness, integrity that it takes to get someplace. Everybody at the firm, and we have 3,000 people now directly, and we control companies with another 500,000. So this is actually not a little thing anymore, but we think about it like it's a little thing.
So how have you, if I could just double click on that, how have you personally evolved your management style from a company in which people connected with you and kind of felt your energy and your value system to now a company that's managing thousands of employees? And how do you maintain that same value system, that same alignment?
Well, actually, that's part of the trick of running a great firm. And the answer is we continue to be in everybody's face, just like the people on this call keep touch with the people who work for them. And so in a way, that immediacy of the small organization has to be shared with everybody. So what we do is we start each week with what we call Blackstone TV, which is you have the leaders of the firm, our head of government relations, sometimes our general counsel, just speak to everybody at the firm. Video allows us to do that now with Zoom, and so we basically have fun. We let people know it's like everybody's at management committee. Here's what we're thinking about. Here's what's going on. So we manage the business very horizontally, and we're very open so that everybody feels that they're involved with what we're doing, and shares our values and our hopes and our aspirations, if you will. And then each of our major businesses meets for about an hour and a half, sometimes 2 hours, all day Monday. And there are like 4 of us who go to every one of those meetings. And if it's private equity, we go over all the private equity deals. We make comments, everybody else can make comments. And so everybody at the firm sees a lot of us every week. And I'm a great believer, not in me as a person, the firm's gone way, way, way beyond me. Everybody who's there shares the same belief system.
Yeah.
And as we grow it, we want to make sure that whatever we're doing can be folded into the kinds of meetings we have on Monday, so that everybody understands what we think about everything that's going on. We can have a dialogue. It's not meant to be didactic. I learned from all these meetings, for sure. And so in finance, unlike some of the people on this call, in finance, nothing stays the same. And there's no patents to protect you, so people can imitate what you do.
Mm-hmm.
So it's a constant struggle for innovation, for seeing new patterns about where you can invest, and it's part of keeping people excited. It was fun today. Before I was doing this, it's the time of year where you decide who you're going to make partners at our kind of firm, and so I interview everybody. So this is a nice break for me. And we had a remarkably talented younger person who happened to be in our private equity area. And I said, how do you like being at the firm? He's been there for, sort of 12 years. He said, Steve, it is so much fun. I'm excited every day. And I'm doing all these new things, and I'm doing some of the biggest things in the world, and they're working out wonderfully. And I just sort of can't wait for tomorrow. And I said to myself, how wonderful that we can have amazingly talented people fired up. And we have that all over the firm, because at our place, if you don't feel that way, you shouldn't be there. Right. Because it moves fast. It's like being on a really great NBA team. And can you imagine being on the court if somebody's throwing you the ball and you don't bring your hands up and hits you in the face? That's the end of the point, basically. But you just can't be on the team.
Right.
And so we have that spirit. It's not because of me. It started because of me, but I'm sort of getting older. I mean, I don't feel older, but CDC says I'm elderly, so I can get vaccine or something. But now everyone who's at the firm has grown up in this system. So if somebody else shows up and we make a hiring mistake, and they don't have this drive, and they don't have this curiosity, they basically leave quite quickly. Not because I have anything to do with it. Well, we have a system where it's sort of like, hey, who are you? That's not how we behave. That's not our values. And if they don't change, then they can't stay.
Right. And so I want to come back to something you said just a little bit ago. You said something interesting about, there are no patents in finance, and you constantly have to innovate. And certainly, Blackstone has done incredible amounts of innovation. But I guess the other challenge of that, the other side, is how do you manage risk as you're innovating? And you've developed a reputation for risk management and preserving capital, and obviously that's evidenced by the billions of dollars that institutional investors have entrusted you with. But what do you believe have been some of the keys to your success in managing risk for 3.5 decades? And after that, I'll probably follow on if we don't get to it. And what are some of the greatest risks that you're concerned about today?
Well, the way you learn to manage risk is by losing money. Try it.
I don't want to.
Right. But everybody, and I would say, I dare say, everyone on this call has lost money doing something. Whether it's buying a stock that they thought was really good that went down, whether it was introducing a new product in one of their companies they thought would be good and it wasn't, um, whether they did a small acquisition and it didn't work out the way they thought, um, whether they did something bigger and that didn't work out. Nobody in finance hits 100%. It's just not possible because there's so many decisions that get made. And so what happens is part of running a great business or running a great family group is learning from your mistakes and never making the same mistake twice. Most human beings try not to even focus on their mistakes. It's quite fascinating, or they blame somebody else. You can't do that because the only reason that person could make that mistake, if you're the person in charge, is that you put that person there. Mm-hmm. And you didn't train that person. So you either hired the wrong person, or they were the wrong type of person for the position, or they weren't trained. It's sort of like not their fault. And you also didn't put in protective systems to protect them from bad judgments. Mm-hmm. So they visited that bad judgment on everyone. Mm-hmm. And so you have to understand that that's the dynamic. And if there is a mistake, and in my case, the third deal we did, we lost 100% of our equity, and I had people screaming at me. For those who don't like to be screamed at, because in my family, nobody ever raised their voice. I didn't realize till I went into college that was odd. I never heard anybody. It's my two brothers, my parents. Why would you ever raise your voice at someone? It just didn't make sense. I don't know. But I had people screaming at me, and I decided that was never going to happen again. So how do you deal with risk? When you don't want to lose money, if that's a sine qua non of what you're doing, well, you learn, okay. There are usually a variety of variables in every decision that involve downside. And what we do is we analyze those, and basically I only pay attention to the top 2 or 3, because those are the ones that really make the difference. And we repeatedly have meetings to debate among ourselves, and everyone has to participate in the debate. I don't believe in, like paid audiences. I don't need anybody at a meeting to watch the rest of us think about that, mm-hmm. Right? They got to read the same stuff. They've got to be a participant. That's the way you train people. Most variables, there's, what's the probability that bad thing is going to happen, and how bad will the bad thing be? Mm-hmm. And so you have that debate rigorously. And if you have 3 different meetings, like on the same thing, by the time you finish with a bunch of smart people in a room, and I recommend this for everybody who's on the call, you really know what your risk is. And we at our firm, no upside justifies risking financial capital. So I know I'm like an entrepreneur. People think I like risk. I've created a lot of stuff. Entrepreneurs hate risk. That's like BS. Entrepreneurs love risk. Who likes risk? You like a good return, but you don't want people screaming at you. And you're like a doctor. It's like, do no harm. Right. Don't start out losing people's money. You'll find how unappealing that is. When they do it to me, I don't like that. So by having that kind of rigorous debate, it's not even that you need a unanimous vote. What happens with smart people, you can see the risk and you say, well, it's just too much. We're not going to take it. The other side of the analysis, of course, the upside. And the upside is much easier. because there's no meeting that anybody ever goes to on a new proposal where there's not somebody believing there's an upside, right? And you do the same process. And by the time you have several meetings, with each meeting resulting in the proposers of the investment having to go back and do the research, that further research that the kind of meeting I'm talking about generates those questions. You just keep learning, and at a certain point you say, okay, we got it, we're okay, we're okay. And what this process also does is it makes the approval of go decisions not the responsibility of the people who propose the investment, because most people who walk in a room think it's their ability, their job is to get what they want approved. Right. And they will shade what they tell you. They will play with facts. They won't lie, but they'll display them in a way that isn't actually balanced. In our place, we don't do this.
Right.
Because when you finish looking at things, it's apersonal, it's non-personal. It's just about the goodness of the investment. And it also protects everybody as people. If we get one of those variables wrong, and we don't have as good an outcome, it's not the fault of the quote team. It's the fault of all of us. We had fair shot on goal here. Right. And so we have a place, every year we've been, for the last whatever, we've been voted the best place to work in finance. And it's because we protect our people, and what we're interested in is a good outcome.
And Steve, other than deal specific risks, are there any broad-based or sort of more macro risks that you're concerned about today? Anything that you could share on that front?
Well, it changed a little with the U.S. elections, but our number one risk is political, and that may be an odd thing to say, but as being a U.S.-based company, we had some pretty odd things being discussed, by the left wing of one of our two parties. And there was a chance that you really could destabilize our own country. And the way the election turned out, that's pretty much off the table. But we have Democrats, and it's pretty clear now Joe Biden's much more of a centrist than the left side of his party. Some good nominations this last week, being president, and on the other hand, the supposed Democratic blue wave, just the opposite happened. The Republicans who didn't like those left-wing policies basically decreased the majority of the Democrats in the House by 2/3. It appears that the Senate will be held by the Republicans as well, which is a break, on some of these excesses that were discussed. 37 of our 50 legislatures now have more Republicans than Democrats. They gained in this election. So the country, in a pretty remarkable thing, decided they didn't want to run to the left, and has now got more balance. Now, in certain states where some of your members may operate, like New York State, it's basically controlled by progressives with all kinds of strange proposals, some of which have become law, and the state is having an extremely hard time with COVID, and the prospects at the moment don't appear particularly rosy. I'm hopeful the same thing will happen, that there'll be a move to the center. What I've learned from investing globally is that bad governments give you bad outcomes, typically, as a business, and good governments have the opposite effect. And so, ironically, government becomes your biggest risk. They're supposed to be representing you and creating sort of a better life for everyone. As it works out, that's the number one source of risk. I mean, you've got the financial system throughout certainly North America, Asia, most of Europe is in pretty good shape as a result of the reforms after the global financial crisis. So finance doesn't appear to be the vulnerability. It's really where we leave ourselves after this COVID situation, which is really devastated individuals and families and put a huge burden on society with increased alcoholism and drug use and depression and unemployment and all these things that go together, and so that's a risk for a society, which also affects the political component. Fortunately for all of us, these remarkable people in the pharmaceutical and research world have come up with a miracle in less than a year. I mean, you've got 2 vaccines already, I guess the third with AstraZeneca at 90%, the Oxford one, with Pfizer and Moderna being around 95% effective. And Johnson & Johnson will report, and I'm sure they'll have the same kind of results. There's a very effective vaccine in China that's been used, and the Indians are going to come out soon with theirs. This is just simply remarkable. And, from watching the media, as we all do, you think that, COVID, somebody won the presidency on that, is going to be with us forever. If you have 95% efficacy and everybody took this vaccine, which everybody won't, but by the end of it, I think a lot of people are going to be doing this, then the impact of COVID is going to go away probably, within, if you had to guess, 12 months.
Right.
And you probably will have much more economic growth, although some will continue to be difficult, and some patterns will change in the economy. Will people travel as much even once you can, or will they like Zooming altogether?
So we just actually get a little deeper on that global economic growth. So obviously, COVID has impacted society and markets in a unprecedented manner, and obviously the vaccine will be a catalyst. But do you see any other catalysts for increasing global economic growth? Because even before COVID, growth was sort of stagnating. And do you see any other catalysts in the picture?
Well, you've already got interest rates that are at such record lows that you can't depend on that. The only way to stimulate growth, I guess, as an economist would say, is you need fiscal stimulus to start growth. I also think that once people feel safe from a health perspective, they're going to come back with the vengeance on certain types of things. I mean, I have nice houses. I think the people on this call probably have nice houses. I don't know how many people want to be sentenced to be in their houses. And there are most of society that have places to live in that aren't so big. And once you tell people, it's sort of like you blow a whistle and you say all safe. That's not going to be in the next 3 months. But as this vaccine rolls out, I don't think you can underestimate
Mm-hmm. Mm-hmm.
the impact of deferred purchases, deferred experiences, and people wanting to reestablish, more aspects of what we used to call a normal life. Now, you won't get stores back in malls in the same way because you don't need to do all that. It's efficient to do online purchasing. That doesn't mean all malls will be gone and all retail will be gone. That won't happen. But the mix it will certainly not dramatically swing back in uh, that industry, but a lot of other things, I think will experience a real uptick.
Mm-hmm. And I want to just, you touched on rates and the fact that the Fed and other measures, central banks have basically cut rates to zero. So given the implication of all risk assets in this kind of low return environment, um, how are you managing expectations of your investors who are used to considerably higher returns, especially over a 35-year or 30-year period that corresponded with one of the most meaningful declines in interest rates? you know, um, how are you managing and thinking about those expectations?
Well, I think what you have to do is you have to be, if you're talking about assets that are equities, equity related assets, you're going to have to be involved with asset classes that have more than normal absolute growth, because that's the way you're going to be able to deal with interest rates when they start turning around. And you have to make sure you don't set them up at such ridiculous valuations that you're in a value trap in that regard. But when you have interest rates that swing up, nobody's even mentioned that interest rates can go up. I don't know. I've been around doing this stuff over 50 years. I found they go up and they go down. And right now, everyone's assumptions is that they'll never go up. What I've also found is that smart people are never wrong with their logic. They make mistakes on their assumptions.
Mhm, mhm,
And the assumption that rates will stay longer for long, lower for longer, uh, that's fine. I'm not fighting that. But what I'm saying, when you rack up all these deficits and you have most countries, uh, fiscal situation sort of a mess with big annual deficits, usually that results in something happening, whether it's higher interest rates or inflation or something, doesn't just stay where it is today, where there's slack capacity today globally for manufacturing, to the extent manufacturing is important, although it's a minority of global economies with services of being higher. So I think, the second thing with our types of businesses where you can control the assets rather than just buy securities, um, that you have to have very robust uh, uh, management plans, business plans, strategic tactical plans to add value to assets. If you don't have that capability, you won't be able longer term, I think, to do as well as you used to. We look at it and say, okay, what does it take? I guess that's the name of the book. What does it take for us to solve that puzzle that you just put on the table? Well, you better buy right. You better be in good neighborhoods where growth is high, and you better have a plan to make that operating asset better than it was. And so I think you can do that. We've managed to do that. I was just talking to this morning another one of these people I was interviewing who work at the firm, and he was telling me how he's worked on a deal, and he just talked to the investment bankers in his country, and one of our assets we're going to take public at 7 times profit. Now, part of that is because multiples went up in India, and we've done a great job with this company. But at some point, it's going to be, like a little harder. We'll find a way through improvements to make sure the returns remain good.
And you mentioned earlier, again, I forget the exact word you used, but above normal growth rates, or above average, or whatever. Where are you finding those above average growth rates? Where are you finding yield? And how do you think investors should be readjusting their portfolios in this type of market?
Well, those are two different questions. The first is that we're finding these types of what I would call very successful investments by staying in successful neighborhoods. So we have a big emphasis on technology and life sciences currently. This is where some very innovative, interesting things are happening, and where we can go places through our knowledge. For example, in life science, our group, everybody's a PhD. Forget guys like me who are just generic financial people. We don't add that much, but we've got people picking molecules that are right to develop and test 94% of the time. That's pretty astonishing. We have a growth equity business that that you should invest in. I'm doing it. Where our first 2 deals are huge home runs, because what we do at Blackstone, which is different, is, for example, if somebody invests with us, we sweep them into our discount purchasing program, because we're one of the biggest business groups in the world. So we buy things really cheaply, and we let anybody who's a portfolio company benefit in that. We also have all kinds of expertise that companies can use, and people are happy to invest with us because we can cross-sell their products within our own group.
Mm-hmm.
And so we start out with almost guaranteed, in certain cases, products, successes for companies that join the group. So all business people, everybody on your call, is probably pretty clever. We all find a way to win. We've got a lot of structural ways of doing it.
Right. And you said those are 2 separate questions. So I gathered the second question is, how should investors be readjusting their portfolios in this type of market?
I think as long as rates remain where they are, which is very low, and governments are flooding, their economies, you stay in equities and you enjoy the ride. Because you've got it all working for you. Forget valuation in that sense. However, when any of those factors change, then you no longer are in the same super stimulated world. I don't know how long that will go on. When you see interest rates starting to go up, the chance that equities will continue performing as well as, I think, lower, much lower. I would keep bond portfolios reasonably short. You don't earn much anyhow. What's an extra 1% of return to take duration risk. I mean, really, families don't think like that.
Right.
You're playing for the long term. So that's, I would look at those macro changes, and you don't have to be a genius. They announce them. And your job is to do something when they announce them, not assume they're kidding or this time is different. It won't have any effect because the ride's been so good.
Yeah. Yeah. No, that's couldn't agree more. Just let me change subjects to something quite different. I want to come to the geopolitical conversation, particularly because of your work, through your work at Blackstone and through your philanthropic initiatives with the Schwarzman Scholars. You've had deep relationships with the leadership in China, and you've kind of had this front row seat to their evolution on the global stage. So, considering some of the recent challenges and kind of the last administration with China, and certainly in the last few years, and now with this new administration in place, what's your personal outlook for the U.S. China relations, and what does that mean for investors globally?
Well, I think there's no doubt that, that the U.S. and perhaps a lot of the West has moved into a zone where they recognize that longer term that they will be competing with China. That doesn't mean that you won't be able to find common areas where two countries can work together and regions can work together. And some of those may change. As the Chinese tell me, we don't want to be American, or we would. So they have a different form of government. It's been around over, in one form or another, from the emperor to the Communist Party, for over 5,000 years. They have a distinguished history. And historically, they've always been, as best one can figure it out, 20 to 25% of the global economy. So China looms very large. We've had a change in the United States, which I guess is officially January 20 to the Joe Biden and the Democrats, and they announced their foreign policy team yesterday. And these are smart, thoughtful people, and they speak relatively softly compared to the current administration, which the Canadians have had a lot of experience with. The Congress in the United States still shares the same basic views on a variety of issues with China that they had before the election and after the election. I think they'll be expressed differently. I think there'll be much more coordination between the United States and its allies. And I think China will continue on its current path, which involves more internalization as a result of being denied, certain high-tech semiconductor and other products. And China will continue to grow faster than any major country in the world, significantly so. This year, that'll be the only major country that's growing. They'll be up 2% probably this year, despite COVID. It's pretty amazing. And so China will grow. I believe there'll be more re-engagement between the new Biden administration and China. What that results in is too early to tell. There'll be areas where the two countries, which comprise together, just to shock you if you learn nothing else in this call, China and the U.S. together are, depending upon which set of numbers you're using, is somewhere between 35 and 40% of the entire world's economy.
Mm-hmm.
Now
Mm-hmm.
think about that. There, there, there are, I guess, somewhere around 220 countries, something like that. And so 1% of the countries have 35 to 40% of the whole pie.
Mm-hmm.
So what that tells you is that there will be relationships between those two countries and their allies. And the only question is how much accommodation will there be in either side to the, to the issues that are uncompromisable. And what can you do around that? So China's been opening its financial sector. It's slow, but it's coming. And they've given a bunch of people licenses. On the other hand, on certain tech areas, they want to maintain control of what their people know and hear and see, and they are not going to vary on that.
Mm-hmm.
There's a whole bunch of things that they will over time do by way of reforms. And in the shorter term, there are all kinds of things you can do on climate, on health, on terrorism, where our interests are basically aligned.
Mm-hmm.
And so we'll find those and reestablish better balance. There'll be some like human rights, where I think we will not see eye to eye on a lot of that, though there may be some areas where we can, but fundamentally they have a different attitude to a classic Western country in that area.
Yeah. Two more questions I want to just cover off with you is because I see we're kind of edging in on time. One, if you were restarting Blackstone today, what would you be doing differently? And essentially, I'm asking, what's the vision for the next 30, 35 years? But I'd love to hear your thoughts on what you would do differently if you were starting today.
Well, geez, I'd be successful right out of the box and I wouldn't have the scars. I'd know what to do because everybody on the call knows as you become more experienced, you learn how to do things better. You may miss something that's a late breaking news item, but your basic managerial skills are better. Your ability to deal with people, anticipate things. It's the nature of experience. In most cultures, it's sort of venerated. So I think if we started Blackstone again, we'd have a different change in focus as what we did 35 years ago. You'd have much more sort of a tech, life science, growth equity focus. We're the largest, Blackstone is the largest owner of real estate in the world, just by the by. We're really not a private equity firm. They call us that. We have almost $600 billion of assets under management. And that understates really what we are, because that would be asset under management would be the equity, for example, in a company you own. It wouldn't be the value of the company. I mean, it wouldn't include the debt and the capital structure. And so we're probably getting a lot closer to $1 trillion. I mean, this is big numbers. These are U.S. dollars. I would do the same thing in terms of identifying asset classes that are really going to do well. The strategy we have is still the right strategy, which is why we're continuing with it, which is always going into new areas when they're either cyclically depressed and coming out, one other helpful hint to you is don't pick bottoms. One, you're not that smart. Two, nobody knows. And three, sometimes you stay at a bottom for 10 years.
Yeah.
You picked a bottom. It just didn't come out. And there's nothing like having dead money. Real estate in Houston, for example, you could have bought 1982 or 3 when oil and gas prices plummeted. In 1992, office buildings in Houston were the same price, right? So picking bottoms isn't a good idea. Another lesson for you, which I knew then, but I know better now, is when things are at cyclical lows, wait until they start recovering. It doesn't matter if you miss the first 10 or 15% of profit from the bottom. What's important is that the circumstances in that area have changed, and you can get on that train at any stop, right? And you load the boat as it's coming out of the bottom, but you don't load the boat on the way down and when it is at the bottom, because if you buy too early, you waste all your time and have the psychic pain of losses waiting for things to turn. And if you buy at the bottom, unless it bounces, you don't make anything for a while anyhow. It's easier to just always make money, and, right? And to do that, you just wait till they start going up.
Yeah. No, I hear you. Let me just ask one last question, because we can't, particularly because this Lunches with Legends is a charitable endeavor. I think it's appropriate to just mention, first of all, you signed your name to the Giving Pledge, and you have made some of the most transformational gifts. So maybe if we could just close up with, what does success and impact in philanthropy mean to you, and how do you measure it? I mean, the MIT college in artificial intelligence. Like, how do you measure the success of these things? I mean, they sound remarkable, but what does it mean to you?
Well, I tend to get attracted to things that I see going on where I either can anticipate something very bad happening and want to put something in place to stop it, or I could see the benefit of doing something that's very substantial. So just by examples, Schwarzman scholars in China, sort of 2011, I sort of anticipated that if China was going to grow very rapidly, eventually they were going to create friction with the rest of the world. And I wanted to put something in place to have future leaders in the world, sort of graduate school level, like the Rhodes, sort of see what's going on in China and go back to their countries and explain to them what China was thinking, but also feedback loop to China to tell them when they were doing something that wasn't really selling. And so that was, trying to protect the world. And we still serve that function now. Almost everybody else has been marginalized, and we're in good graces in China. We just, if you can believe this, we had sort of a 4% investment, 4% acceptance rate in this program, more competitive than Harvard or Stanford. And we made offers to roughly 156 people. We got 153. I mean, this is like surreal. And they're all from those kind of very excellent universities. So that was one thing. But the College of Computing at MIT is based around artificial intelligence, which has the opportunity to be a force for good, using AI to develop new medicines and efficiencies, or a force for not so good with large scale unemployment potentially and other things. So being involved in that both on the technical side, but also on the ethical side, to train scientists to be sensitive to what they're doing, as well as the business community, I think you can measure how that's going to work. I did a program at Yale where I went to college, and I'm sort of loyal to them. You know, I turned up as sort of a bumpkin, you know, I left with a really good set of values and a lot of knowledge. What I'm doing there is building their first student center and a performing arts center, and it's going to be the center of campus. They never had a center. They operated through the Oxford, Cambridge college system without a central core. So now we're going to have a central core. We can have graduate students, professors, and undergraduates all be in the same place. It'll handle thousands of people. It'll be open most of the day and night. It'll have all kinds of things. All the clubs from the university will meet there. It will be the hub, and it will change people's relationships. It'll change the university. It's got the perfect location, right? You know, in the center of the university. And I've done something very large for Oxford, combining all of their humanities faculties and doing a big performing arts center and starting another AI ethics operation. But there, it'll be domiciled out of the philosophy department, which is #1 in the world. And their humanities area is #1 in the world. And so something magical is going to come out by tapping into Oxford in all of their major areas to focus on what's good or bad for AI. So I do things because I think we can affect large scale forces and nobody else in effect can do those because they haven't done them. Right. And you know, you have to be a little deranged to do these types of things, because when I think about them and develop them, they're very expensive. Right. And usually somebody says, well, you're going to pay for all this, aren't you? And you look at them and you say, you must be kidding. This stuff is like, you know, at MIT, I was worried about U.S. competitiveness. I wanted to make sure MIT had a dream that they'd love. You know, I was working with the president. I said, what's your dream? And because I saw all the AI being developed in China. Mm-hmm. And he said, well, my dream is to, I'd love to double my faculty in computer science. I said, okay, what else? He said, well, you know, I need a bunch of these people to basically take my entire university and make it AI enabled. So we'll be the best generator of knowledge in the world. Mm-hmm. And I said, yeah, that sounds pretty good. He said, yeah. He said, you know what's going to happen? I said, what? He said, every other major university is going to compete with us because they don't want us to be #1. They want to be #1. And he said, this will result in a huge explosion of money and effort put into this area, which is important for our national interest, but also for science generally. So I looked at that and I said, okay, this is terrific. I said, how much does it cost? He said, I don't know, it's just a dream. I said, well, price it out. So it was $1.1 billion. So he said, well, why don't you give me $1.1 billion? I said, why don't you just sort of jump off a ledge? I said, I'm not going to give you $1.1 billion. And, you know, so we negotiated. I gave him $350. And then because I'm not a scientist, I said, if I'm going to give you $350, you have to put up $350. Mm-hmm. Because if you don't put up $350, you're the guys who know what they're doing. Right. I just sort of have a hunch. And I said, if you put up 350 and I put up 350, then it's, we're at 700 and we're in great shape. We'll raise the other 400, which is what we're doing. And, so they did it in 3 weeks. They
Amazing.
put the money up. So each of these projects, over the last few years, I've done like $1 billion, of my own money, and, created these really marvelous things, for the good of the world.
Yeah.
And for me, I just respond to things where I think there's a compelling need that nobody else is either filling or probably will.
Yeah.
It's no different than when we go into a new area in our business and people aren't filling it. I usually like going in first,
Yeah.
and if I see it, and those have almost all of them have worked hugely. So that's what I do. It's sort of fun.
Steve, that is fantastic. On behalf of all of us, kudos to you for all that you do for our country, our world, Blackstone, for your investors, really. And thank you so much for sharing your incredible insights with us. We really appreciate your generosity of time and wisdom and hope to do it again soon. Um, and for all the participants, really thank you for joining us. And if you haven't yet donated, please do so by going to the top right of the website, click on the link that was sent to you. And lastly, we'd love your feedback on how we can make these conversations better every time. So please complete the survey. At the bottom, make sure, pick up one of these. Absolutely. The Steve's book. By the way, anybody donates $1,000 or more by end of day, I'll personally send you a copy of Steve's book. And really, Steve, thanks again for your support of Lunches with Legends and the
Thank
charitable projects it's sponsoring.
and thank you very much. And if you want over time, you should invest in our Blackstone products. And I say that because I do,
Yeah,
not because you should. These are good things to do with your family's assets. That's what my family is basically invested in.
absolutely. Steve, thank you so much for your participation. I look forward to seeing you again soon. Wishing everyone a wonderful day.